what was the most challenging part of that first deal for you? Was it raising the capital? Was it doing the renovations? What would you identify as
Honestly, it was so
challenging for you?
easy. The first deal, the second deal, I mean, till now, we didn't see a deal where we struggled. See, buying is one thing, operating is a whole different thing, right? People think that once you buy it, it's successful. No, no, you'll be successful once you buy it, you fix it up, or whatever business plan you execute it on time, on budget, and you sell it and make profit for your investors, then it is successful.
This is episode number 15 of the Multifamily Success Stories podcast. Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
And Julian Sage.
and welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, Dealmakers? Julian here, and in this episode, I have the special honor of speaking with Venkat Avasarala, co-founder of Raven Multifamily. Raven Multifamily has been investing in the multifamily space since 2016 and has since acquired over 2,900 units and $250 million of assets under management. In this episode, Venkat shares his journey from purchasing 20 single-family homes to acquiring his first multifamily deal of 100 units, how he went from an IT professional to a real estate professional full-time, and why they are investing into development during this time as opposed to their traditional B and C class properties. If you like my show notes for this episode, go to multifsuccess.com/EP15, or if you'd like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, Dealmakers, to another episode of Multifamily Success Stories. In this episode, I have the special honor of speaking with Venkat Avasarala. Venkat, if you please would introduce yourself to the Dealmaker community and let them know who you are and what inspired you to get into multifamily investing.
Sure. Thanks for having me, Julian. So I started in real estate back in 2007. That is when I still had a day job back then. I was in IT. And I just moved to Dallas after roaming in different parts of the country, consulting in IT space. So I moved to Dallas in 2006 and then immediately start looking at some passive income opportunities. So 2007 is when I really started buying some foreclosed houses, basically single family houses, to hold them as rentals. I just didn't have a bandwidth to run a tight operation that would be required for flipping business, even though it does make some sense. At the time, there was so much product out there and you can quickly flip and make a quick buck. But it's just that I have my day job and just couldn't run that tight operation. So I settled for single family homes. So ended up buying 20 of those, all with my money, and operating them on the side. There's no property management involved. I ended up managing them myself. And then later in 2016 is when I entered into multifamily space and took a partner, started a company, and ended up buying about 3,000 units, mostly in Dallas area.
Wow, big jump. So definitely want to go back to your kind of the beginning. So you said, IT, so you're saving up a bunch of money. And during this time, you were thinking that you wanted to get into real estate. And the first thing that came to mind was, let me buy 20 single family homes.
Absolutely. So, the progression to real estate was not very abrupt or natural, but rather while I was traveling, right? I worked in Houston, New Jersey, and Bellevue, Washington before I settled down in Dallas. And since the transient nature of my job and all that, I didn't want to get into real estate. That's the last thing on my mind. So I was doing some stocks, right? Like everybody, right? It's easy, right? You open up an account and then boom, you're in the business in the next 10 minutes. So I did something like that at with stocks. And what I realized there is it's a rocking chair, right? The greed and the fear gets into the picture. It's so easy to get in and get out of the positions, react to the newses and things like that. So what I noticed is 2004, 5, 6, if I look at my tax filings, right? Yes, I made money there. I lost money there. Net, it's a small negative. So I quickly realized I'm not cut out for this. It's just that, I'm getting in the way of my own success here. And also, it needs a lot of, you might put in few thousands into a company, but you might have to spend quite a bit of time in researching that company, even after you buy it. Because nobody's going to call you and tell that, okay, Venkat, now go ahead and sell, right? So it's on me. It's buy and research. It's just too much for me. Figured that I'm not making any progress. I would need something more predictable that I can throw it in a spreadsheet and with reasonable predictability in it. So I like real estate that offers that. It not great returns or anything nothing. It's not going to be a Tesla stock or an Amazon stock, but you'll do okay. And I settled for that.
So 2007, was this right before the market crash, or was this? So you came in at real prime time.
Sure, but what happened is that in 2007, I bought 3 single-family properties. They were cash flowing well, $500-$600 a property per month. I mean, I'm more than happy. But then again, this 2008 comes, and a couple of things. Actually, I was very, very busy. I was managing a large team at the time. I was working at PepsiCo site here in Dallas, and it's very, very busy time in my life, in my career. So didn't have a lot of time. And also, what happened is that whenever you hear media, it's like doom and gloom. Glenn Beck comes on TV and says that we are over. This country is over, right? It's not going to come back. I mean, it's a lot of doom and gloom. So long story short, basically I got freaked out a bit and stayed out of the market for 2008, 9, 10, and 11. 12 is where I got back in because I can clearly see that the economy started to take off. In 2011, it appeared that we are doing progress, but then we got that double dip recession there. But 2012, the signals were right. How do I know that? Because until 2012, brokers used to call me, asking me to buy their house, right? Well, in 2012, they stopped calling. I knew something was up, right? So then I started paying attention to what's happening there, and I can clearly see an indication that the market's back and going up every month. So starting 2012 all the way to 2015, I purchased another 17 properties. But then that is when they cut you off, right? No more Fannie Freddie loans. But by 2015, I couldn't find the deals which make a whole lot of sense with bank loans and portfolio loans because Fannie Mae only gives you 10 a spouse. There was no limit before recession, but after recession, they put a limit of 10 loans per spouse. So I was limited there.
So you were purchasing these properties basically like turnkey? Were you doing any fixing up on them or anything?
I did both ways. I had bought some from wholesaler, fixed them up myself. Whatever little time I have some trusted teams who fix these properties with me, and some I used to buy actually from a flipper. Either way, we did okay because at the time the house prices were so low, it still was okay.
How much were you having to like put in your own capital into all of these properties? Was this something where it's like you were dumping all of your savings into this, trying
Absolutely.
to raise your passive
But then
income?
again, I'm making that money back also, right, on a monthly basis. Every property I buy and some of the properties I actually bought a tenant in it, with a tenant in it. So a wholesaler acquires the property, and not a wholesaler, a flipper, right? So they actually do the rehab, and they know that I'm going to close on it. So I tell them, okay, go ahead and put a tenant in there so that it cash flows from day one. But yes, I was in for anywhere between $20,000 to $30,000 per house. Both me and my spouse were having IT jobs, and we were living significantly below our means. So it's leaving a lot of cash month after month so that we can invest, and also took advantage of this. I wouldn't advise it to everybody, but I did it okay. But I got this credit cards, which they used to give. They don't give it that today, to the best of my knowledge, but back then, 0% for 18 months all day long, right? So I used a fair bit of that money also to get me started. But then again, as you acquire property every month, you started bringing in this cash, which helps you further along.
What were some of the big takeaways that you learned with your experience with purchasing these single families?
So single families, it's all fun until it becomes a certain number, right? And definitely try to do it. If you're doing it for cash flow, you absolutely have to self-manage. I do not recommend hiring a third-party management for a couple of reasons, right? I mean, there is a 10% fee that you have to pay. But that's the second reason why I don't recommend property management. But the first reason is this conflict of interest. So when they bring in a tenant, they get 50% to 100% of the first month's rent. When they renew, maybe they get what, $100? So it's not in their interest to keep renewing this tenant year after year. They don't make much money that way. So when I manage, I have my tenants a minimum of 5 years in these properties. And one tenant ended up living there 10 years. And the only reason they moved out is because they bought their own home, right? So self-management is key if you're cut out for that. It's not for everybody. I get it. And it's not like, where they're going to call you for this and that. I mean, you can set up a process. What I did was I had some trusted vendors, a good plumber, a good HVAC guy, a good handyman, and a good electrician. These four people, if you have somebody that you can trust, can cover 95% of the issues, which comes, right? So the tenant texts me and I forward the text to the service provider, provide them the name, address, and the phone number, and brief description on issue. And the service provider calls the tenant, set up an appointment, provide the service. Unless it's a big ticket item, they won't even let me know, right? I mean, they just provide the service, email me an invoice. Over the weekend, I just download the invoice and I'll kind of check for them and then put in the mail. And nobody talks to nobody, but I still can provide a same day service. So I treat my tenants as if my own mom is my tenant, right? How would you react? I react with urgency and they like it. And that's all the tenants want. I mean, that's why they rarely move out of my properties. So, but what happens is after those 20 properties, right, it adds up. So something is going on some property at any given day or week. And then what happens is you're not making a whole lot more income, but your work is steadily increasing, right? Because these properties are aging. The rehab that you did years ago is not brand spanking new anymore. So these things do come up. And that is why I figured that, in order to scale this big, I mean, with 20 properties, on average around $400 to $500 per cash flow, and bringing in $8,000 to $10,000, even after allocating 15% of the rent towards maintenance, right? So it's good money. But not something that you can go ahead and retire off that, right? I mean, you do, in these days, looking at how the costs are living in a big city, it just don't give you a whole lot of confidence to go ahead and retire. So that's why I moved to multifamily to scale bigger so that I can acquire and leverage other people's money, other people's time, effectively use property management. So that is why I chose the multifamily route to scale from there.
So 2015, you had around those 20 properties. 2016, though, you started Raven Multifamily with your partner. How did you go about starting in multifamily? Did you go in first as an LP on a few deals, or did you co-GP? How did you get your step into
So
it?
that is exactly how I did, right? I mean, with the advent of technology, the meetups or whatever, right? I mean, if you 10 years back, there's no meetup, right? In order to get hold of somebody with the similar interest, it's hard, right? Once in a while, there'll be a conference, but it's not like how it is today. There's no Facebook groups. There's no nothing. But once due to the advent of the technology, there's so much going on, the conferences, the meetups and all that. So I was paying attention to those things and actually joined a group myself in Dallas. There was an investment club. So I joined there. Wasn't convinced that, this is workable. So it's not a mistrust. It's something that I don't know if it'll work or not. I have to see it with my own eyes before I jump into that kind of thing. So I took a little bit of risk and make about 3 passive investments, 3 LP investments. And then I started getting checks every quarter. And I said, yeah, this works. I mean, this really works. So that is when I actually started. So I started that back in 2014. 14, 15, 16, 14 and 15 is where I made those 3 investments. And then in 2016, I mustered enough confidence to jump in myself. And by that time, I just took a change of jobs. It wasn't doing contracting anymore, consulting anymore. Rather, I became a permanent employee where I can work 40 hours and the rest of the time is free. In consulting, it's not quite like that. I mean, you're expected to work a lot more than 40 hours. So that was a calculated choice that I made, that I'm not going to travel no more. I'm not going to consult no more. I'm going to take a permanent job, set my hours, and then use the rest of my time pursuing multifamily. So the timing, everything worked out. And that is when I started in 2016. In the investment club, I met my partner, Ramna, and we both scaled from there. We started with a 100-unit property. Our very first property is a 100-unit property in Norman, Oklahoma, college town. And then we bought our second property in Glendale, Arizona. And you might ask, hey, you guys live in Dallas. How come you're buying everywhere except for Dallas, right? Dallas was super hot market back then. It still is. But back Dallas was like the shining diamond in the whole country at the time. So even though I live here, we couldn't land even a small deal, a 50-unit deal. Nobody's giving it to us. So we said, you know what, we can keep trying this and see eventually at some point, maybe somebody will give us a deal, or maybe we'll go out, prove ourselves and buy our way back in. And that's exactly what we did. We just didn't waste much time, did a deal in Oklahoma, did a deal in Glendale, Arizona. And then from that point, we keep buying in Dallas until our latest deal.
So a couple of things. First is you said you actually took another job full-time. You full-time doing IT works still?
Yeah, this is all IT work. But what happens is when you are a permanent employee somewhere, your hours are much more fixed, right? I mean, you're not expected to work nights, weekends. They don't throw you into the fire in the last minute, that kind of thing. But if you go work for a consulting firm, the client pays the consulting company a very big dollar per dollar rate, right? So they don't care. I mean, they need firefighters. Say, look, come on, get in there and just take care of it. And call me when it's done. I don't care it's night. I don't care it's weekend. So it's much, and the travel. The job is not always where you live. And you got to, there was one time before I took this permanent job, for about 6 months, I was working in White Plains, New York, living in Dallas. So every Monday morning, I hop on a flight, come back on Thursday late night, and sometimes even Friday night, and then Monday morning you go back. Changing time zones, losing time in travel, getting fatigue, and all that. It's not conducive for you to go and pursue something like multifamily, because you have to understand, when we entered multifamily, we started syndicating. Me and my partner raised $80 million from people like you and me, not big institutions, right? At $100,000 check, $50,000 check at a time. So when you take other people's money, it's good, right? I mean, real estate, we can leverage it to meet our own financial goals. We can leverage other people's time and money, but you got to be very respectful of their money too. It cannot be an afterthought, right? So you need to have that time and attention dedicated to managing that set of the business, so that we never keep other people's money at risk. But if you do that, well, not many people will be willing to write checks for you for much longer.
What are your thoughts and opinions when, there's maybe a lot of very ambitious people and they're ready to jump out of their jobs and just dive into multifamily, but it seems like, you're in the IT industry and you even positioned yourself so that you could have a full-time job. What are your thoughts on working maybe a job that isn't related to directly real estate or multifamily, and doing this on the side while still growing and managing other people's money, doing these deals?
So it comes down to the personal preference. What I did was, from 2016 June is when I bought our first property. And until 2018 July, I was doing both. So 2 years, it's nonstop, right? I used to work 16 hours a day, not much family time, not much fun. Used to work 7 days a week and all that. And I felt comfortable doing that rather than just giving up my job with a large bank. It's not a cushy job or anything, but it's a much secure job. So I didn't feel comfortable doing that. I don't know how the future is going to look like, right? Let's say COVID came in 2020, but had I quit my job in 2016 and 2017, COVID came, I would be in a very tough situation, right? Wouldn't you agree? Right? All the deals stopped and things become harder and all that. So that's why I didn't go that route. I chose to do it together. But there is a alternative school of thought, right? Where, you know what, just throw the life jacket out and just jump in, right? Right? So that you work like your life depends on it. Maybe you can. That's a good way too. But you should be able to handle that stress. You should be able to hold that weight on your shoulders. But if somebody have a personality to do that, why not? Absolutely. Obviously, we have to see that, in my case, I still have my spouse who has a W-2 job herself. I mean, I have financial security. I mean, as long as we have either a second job bringing in the money in, and also as long as we have some savings, because we don't know when we're going to get successful if you go that route, right? I don't see why not, but it's a personal preference, I would say.
And with that first deal that you did in Oklahoma, you said that's 100 units. Were you raising capital for that, or were you using your own?
Yeah, we raised about 1.2 million.
1.2 that you raised for that?
Yeah, that's our very first and the lowest raise we have done.
And what was that experience like for you, trying to raise that money and find that deal, go through whatever you had to do to get it up and running?
Absolutely. Yeah, I mean, I had some help, right? So me and my partner, we worked very closely with somebody who has purchased a property in that same market. So we got a ton of help. Say real estate is one of these areas where people, I don't know why. I mean, you don't see this in any other industry. They help each other quite a bit, right? You shake somebody's hand in a conference, 2 weeks after you call them, you remind them of how we met. And they're like, yeah, tell me, what do you need? It's phenomenal, right? I mean, real estate is one of the very few areas where people help each other quite a bit. So we did get ample help and advice and things like that. But it's a bit difficult to raise money when you don't have a track record. But what you can do is you can bring somebody who has a track record and keep it all transparent, right? I mean, hey, this is our co-GP. This person has done this and this and this, and we together are a team, and we're raising money together. So you can borrow somebody's resume in a very straightforward way. There's no tricks, no gimmicks. You're all GPs, and then that made a lot of sense and a lot easier to raise money in the first couple of deals. Yes.
And so, maybe people don't realize or understand how much is involved with getting into this, but how big of a difference was it from you investing in, those 20 single families to you having to invest in multifamily?
Definitely, right. A lot less work, right? I mean, I don't have to worry about, if you think about it, right? I mean, every single family house, you need to take care of the insurance, taxes. If city guy writes you up, you have to deal with that. And if tenant brings any problem onto the property, you got to deal with that. The rent collections. So I use some best practices. I used to take my time when I'm picking the tenant, especially when so many tenants. Dallas has been very kind to us, right? I mean, anywhere in the Metroplex, you put a property on the market, you get like 10 of them, right? So you can actually pick the best tenants after you see their credit histories and their backgrounds and everything. So I have not evicted even one tenant so far, right? All these years. So I think I picked the right tenants, but still once in a while they get into trouble paying rent, and then you have to work with them. Again, if you're talking about one or two or three properties, no big deal. Once you have 20 properties, and if you are the only person, you don't have property management like I talked about, it's gonna look like a job, a small job. So going into multifamily, again, we can leverage, we can buy bigger deals, we can have a full-time third-party management who doesn't have an incentive to kick a person out, right? Because we pay for the payroll, everything, right? So it's not like managing a single family property where the manager have every incentive to get a brand new tenant every single year so that they can make a 50% to 100% of the first month's rent. So there's no such conflict of interest in this thing. So I liked it. I really liked it. And it let me scale. And the ultimate objective is to be financially independent, right? Which I was able to do. I was able to give up my job in 2018 July. I just resigned, and then I said, this is what I'm going to do full time. I set my own hours. Of course, it's not cake in the walk. Walk in the park, but it has its own challenges. But at least I'm not dependent on anybody, and that's a great feeling.
What was the most challenging part of that first deal for you? Was it raising the capital? Was it doing the renovations? What would you identify
Honestly,
as
it was so
challenging for you?
easy. The first deal, the second deal, I mean, till now, we didn't see a deal where we struggled. See, buying is one thing, operating is a whole different thing, right? People think that once you buy it, it's successful. No, no, you'll be successful once you buy it, you fix it up, or whatever business plan you execute it on time, on budget, and you sell it and make profit for your investors, then it is successful. So people ask me, oh, how difficult was it? It's not difficult at all. I mean, if you work with right people, get the right advice. Um, Again, I don't want to make it sound like it's super simple also, but we didn't struggle. We made the right decisions. We shook right hands. We made right phone calls. It worked out. Wasn't an issue. But when we buy the property, managing them, yeah, I mean, we got into several times into issues with the property management companies, especially. Again, it's a good practice to, if at all you can, if you have the skill set, time, and the thick skin, you should self-manage. There's no two ways about it. If you self-manage, you obviously will perform better.
Did you self-manage that first 100 unit?
Not multifamily. Again, you need to have skill set, right? Anybody can open a management company. I see a lot of owner operators, but not all of them are successful. It's not automatic. Oh, you went from third-party management to self-management. Okay, you're definitely going to say it's not, because it's the skill set. You should be able to motivate, hire and retain quality people, and run a tight ship, put a right processes in place, provide superior customer service to your people. It's a lot of skill sets that one has to possess in order to bring the A game in there, right? Which I personally think I can do it. But then the other things that you need to have is the thick skin I talked about. What am I talking about? That is, at the end of the day, we are buying B and C class properties. We want yield, right? So this is not your best tenant. This tenant will not be anywhere close to the kind of quality of tenant I was getting on my single family homes. You see what I'm saying? Different kind of tenant. They do crazy stuff sometimes, right? You got to deal with all this thing and should not let all this thing get to your head, right? So it's not that easy. So if you have that kind of personality, if you have that patience skill set, then it would be great. Alternatively, what we can do is, we are actually thinking about it now, or me and my partner, is to partner with somebody who has these skill sets, and then self-manage and run as a unit. So that is something that we are just thinking at the moment, rather than just going willy-nilly and hiring a property management company. And what's happening with property management companies is, it's a very low margin business, even property management, right? So what happens is, everybody tries to grow to this 5, 10, 15, 20,000 unit portfolio so that they can see some money at the end of the month, right? Because it's very thin margin. But the problem with that is, if you grow like that, you have to grow organically, right? But you cannot be managing 1,000 units in 2020 and 2020. By 2022, you're managing 10,000 units. Organic growth is not possible. You cannot get hold of that many good employees and take time to establish the processes to run a tight ship. That's not happening. That's why, a lot of mismanagement happens. But that is where, me as an owner, we bring asset management. We don't go to the property every day. We go there every other week, or if required, we go for a short duration every day. But that's not the whole point. The point with the asset management is, you manage the management company by numbers. This is the pro forma, this is the budget you gave me, and this is what I told my investors that we would do. How come we are not doing? What are the issues, right? So hold them accountable. And there are some times where, a couple of times where we couldn't make it work no more with that particular management company, and we changed the management company.
Did you have any difficulty, being IT background, to moving over to more of a finance numbers kind of role in the multifamily space, or was it a pretty easy transition?
No, it was a pretty easy transition. Real estate is very easy. It's the people that is difficult, because our success, let's say, when I was at my W-2 job, my success, my paycheck, my bonus, my year-end assessments, largely dependent on me and just me. I used to have teams, and some of it is dependent on that, but largely on me, right? In real estate, it's not that. A whole lot of people have to keep their word, do their job, do the right thing, and then I will meet my objectives, right? Um, so people are the toughest part in real estate. So basically, you need to have a lot of emotional intelligence on how to rally people, motivate them, get them onto the same page. We deal with a different walk of lives of people, right? So you look at this lenders, college educated, very refined people, and all that. You meet with brokers, similar background, and then we turn around and look at property managers, and probably their education qualification is just a high school, and they came from a different walk of life. So the success in this business depends upon how well you can interact with people from different walks of life and gain common ground with them and make it a win-win situation, make it equitable for everybody, take care of people and being taken care of, hold accountable people when you have to, make tough decisions when you have to. So that is the toughest part in the real estate. And if you're not good with the people, I'm not saying that if you're not good with the people, you cannot be successful. You just have to partner with somebody else, or you have to hire whoever is good with the people. But that is the quintessential skill. Numbers, that's the easiest part in here.
Was this your first time having to because obviously that first 100 units, your team was probably pretty lean, but as you've grown to now 2,900 plus, your team has probably had to grow. Was this your first time like managing like the teams for your own business? Or
Yes, me and Ramna, we didn't have any experience managing team. We do have a property management company, but we don't manage them. But yeah, we have a 4-member team, not counting myself and Ramna. So that's our asset management team, right? That is how we look at the reporting, the property management software, which is we have full access to that. So we watch these numbers in real time. The trick of in this whole thing with the asset management is you got to take the right decision at right time. A stitch in time saves not 9 but 90, right? So it's very important to take timely action. Otherwise, as you diverge away from performance, it's really hard to bring it back to the to the performer. So, but yes, that is the first time as our business, we started managing teams to achieve success in the management.
and what were some of the challenges that you faced with growing your company and adding the right people at the right time? Were you like earning enough to be able to justify the cost, or was everything a pretty steady growth? Like, how did you handle that development?
Yeah, sure. I mean, see, the very first 1,000 unit, I think we started hiring people only after we crossed the first 1,000 units. Otherwise, you won't have enough revenue to justify hiring people. But afterwards, you absolutely need it, and you should be able to hire people. Not an issue at all. But challenges was, again, it's the people. We hired and fired 2 or 3 people before we have this current team that we have. So it takes a little bit. There is a bit of learning curve in that aspect as well.
And what were some of the challenges that you faced with the growth and utilizing your team? You said that you had to fire some people. What was the reasons for some of those?
Again, you have to understand, on an asset management team, we need somebody who we cannot teach asset management, right? So it's something. Of course, there are some KPIs that my asset manager generates for us, and we review them every Monday. Every Monday, me and my partner have a 3-hour meeting where we review all our properties. We start the week like that. We look at KPIs, right? What are our collections? What is our economic occupancy? What is the renewal rates look like? Effective rents and things like that, right? And then we discuss problems and all that. So that is good. But then again, once this asset manager goes into the field, we expect following things from that asset manager, right? Number one, that person should be able to build rapport, right? However smart one person is, if nobody wants this person to be around them, It's not going to work, right? People don't want to work with somebody they don't like. So you should be likable. But again, at the same time, you should be able to hold people accountable. It's a delicate balance, right? So that skill, if you don't not there, and when I send my asset manager to a property, what will happen is then I'll get a call from property management company. Hey, this is not working out. Our team and your team. It's so easy, actually, for things to get wrong if they don't know how to work with each other, our asset management team and the property management team. It happens. It's far too common. It's far too common, right? So that's one thing. And the second thing is self-startingness, right? I mean, I cannot tell an asset manager on a daily basis what to do. I don't want to babysit anybody. So they should work under an assumption that they're expected to do all of it. If they have an issue or if they don't know how to do something, they can come to me or my partner. But otherwise, we would like them to work independent. And we don't see that scale quite a bit outside. So those are the couple of reasons why we had to fire a couple of people for not getting along with people. And the second thing is for not taking care of business themselves without us telling them to do so.
How did you ever run into any obstacles with raising capital or with the deal flow? Like, were there any things that you saw as a particular challenge as you were scaling?
Lately, yes, deal flow is definitely a challenge. I would say equity is a little bit of a challenge because after COVID, a lot of people got spooked and they want to hang on to their dollars rather because there's still a lot of uncertainty, right? We got to get through this election. We have to get through this upcoming winter. Hopefully a vaccine comes and the permanent job losses are slowly mounting. There's no stimulus coming and people are still, dysfunction in the Congress, right? So there's so much out there which contributes to so much ambiguity on the future. So definitely that is weighing on our equity. But till now, we didn't say no to a deal, not able to close because of equity, right? Sometimes it's super easy, sometimes it's a bit hard. But equity is not going to be an issue. We can solve that problem, right? And also, it's a one-time thing, right? You have a deal, you have 2 months to raise money, and that's it. You don't deal with that every day. But where we are seeing issues is changing fundamentals in the market and deal flow, basically. Yes, there are so many deals, but investable deals are becoming hard to find because of this gigantic appreciation in the property, in the commercial real estate values, mostly due to the cap rate compression, which is mostly due to that interest rates, which are ever keep going down. So interest rate goes down, cap rates follow along. So a $60,000 unit per property not too long ago, now they want 100,000 for it. Well, 2 years back it was 60,000. Now it's 100,000. But 2 years back the tenant was paying 800 rent. Now they're paying maybe 875. They're not paying 1,600. They're only paying a little bit more. So now it becomes a super thin margin business. And then you have to deal with these property management companies and all these issues which that brings along. See, if you have enough cushion, it's okay. If somebody messes up, it's okay. But when you're in a very thin margin business, it became a thin margin business. It's hard. It's hard to make things work. And so that's why it's becoming hard to find those deals where you have enough margin of error, if you will.
How do you work when, like, I mean, you're dependent on this income now, being able to find these deals, being able to raise the capital. Do you ever feel like pressured into, trying to provide deals that maybe where the margins are a lot more thin than you're used to or you're comfortable to, and having to present that to investors? Like, how do you work with that?
Thankfully, I always wish I would have started a little earlier. I always wish that I would have completely skipped single family altogether, right? And started with multifamily. Well, I can change the past. But I was lucky enough to start, me and my partner, we were both lucky enough to start in 2016, which is like really good time. And we had a good run, right? 16, 17, 18. And COVID, until recent COVID, everything was hunky and dory, so to speak. So we had that luxury. By the time we have already amassed this many units, and now we're not hungry or we don't feel compelled or nothing, right? I mean, we are still a lean team compared to the portfolio that we have. So we don't have to go do a deal to get a fee so that we can pay that person. We don't have that situation. We're blessed to be in that position. But if somebody who's starting right now or started maybe late 2019 and all that, I don't know what's going on through their lives, because they will be actively looking for these deals, but the pricing is not coming down. The rent growth will disappear in most of the markets, right? I mean, I don't expect any rent growth in anytime soon because of this impending issues that we talked about earlier. So for them, it will be very hard, but thank God, I mean, we did pivot a little bit though. So early this year, in 2020, where we see these uh, previously, if you go 3-4 years back, A-class property used to trade at maybe 5 cap, B at maybe 6.5, C 7.5, even 8. I'm not talking about ancient history. I'm talking about 2017. I remember the cap rates being that way. Today, A, B, C, everything is 5 cap, right? All of them, right? So we started to think, I mean, if it's everything is 5 cap, why should we buy a C class property which has more lift, right? I mean, more hard work, right? Because the things that we take granted for A class is not so granted. Let me talk about that. AC. If you buy a property with chiller, you can't take nothing granted. You got to babysit it quite a bit of time because it's an older property. Plumbing is going to be an issue. Roof leaks is going to be an issue. Ground movements, sewer line separations is going to be an issue. So then we started to think that, why do we have to buy B and C class if it's all five cab? And then we started looking at new construction deals. And then we further, why can't we even build it? Why can't we even build it? So then we started aligning ourselves with a couple of, very seasoned developers. Both of us didn't have any construction background, so we don't want to jump in. We talked to some people that advised us, you know what, you don't really need a developer. You can go hire a GC and develop yourself, and you learn on the job. Whether the cap rates are at 5%, 6%, or 7%, or 8%, the construction cost is more or less the same. Right? I mean, they don't work based on cash note. The land cost is whatever it is, and the construction cost is whatever it is. It's just that if the cap rates are low, the developer can get more for the property they just developed, right? So it's more profitable to develop when the cap rates are low. When the cap rates are so high, let's say we're back in 2008, 2009 time, when the cap rates are at 8, 9, 10%, don't bother developing anything. Go buy something existing. It just doesn't pace you enough to go through all that ordeal. So given that we are in this low cap rate, and what we thought is that after COVID, oh my God, cap rates is going to spike. No, they even compressed because the interest rates even further came down. The cap rates even got compressed. So we figured that construction is actually offering a better risk to reward ratio. So we aligned ourselves with a couple of good developers, seasoned developers, and developing a project, 156 units in Princeton, which is suburb of Dallas, and we're building a retail of 100,000 square feet retail in a very affluent area called Fulshire, Texas, right next to Katy, Texas. And we probably will get into another deal in next month. It's going to be a 300 unit a ground up construction in Kyle, Texas, which is south of Austin, in the path of progress. Again, if you see that these are all mostly burbs, we haven't gotten into a place where we go into the middle of a big major metro and start doing a big vertical development. We're not there yet, but this is where we feel comfortable, and it offers a good risk to reward ratio. So we did a couple of days construction and about to do a third one.
And does it matter which type of class property? Is it A, B, C, all going to be the same type of returns?
So when you try to build something, it's hard to build anything but an A. I once in a while I hear that somebody has built a brand new workforce housing, but 9 times out of 10 they are built on tax credits. For all purposes, it's an A-class construction. The finish outs might not look that spanking new and nice, but they're built with tax credits, low, to keep the rents lower and all that. I don't want to. I just don't have any desire to enter that space. Building with tax credits, it's a whole different ball game. But yeah, mostly it's like A or A plus kind of a deal, right? So a 4-star property or a 5-star property. CoStar, if you talk from CoStar terminology, they give stars, right? 1-star, 2-star, 3, 4, 5-star. So basically, all the brand new construction is either 4 or 5-star. There's not a lot of cost that you can share. You can always save a little bit on the land cost, but still $10,000 a unit is where if you want to build something decent, that's the money you have to spend. So it's not a big factor. So what we are doing is we want to build anywhere between 130 to 150. And again, it changes from market to market. In Texas market, we want to build anywhere between 130 to 150 and sell it anywhere between 180 to 200. So that's the business plan, having that $50,000 spread, which is hard to do. Let's say if you go buy a 120,000 Class B property, it's hard to produce a $50,000 spread on that one. Yeah, you don't have to do any work. I mean, it's already there. But generating that spread in next 2 to 3 years is going to be very hard. But here we can do that. Yeah, this is our, elbow grease, if you will.
So you're doing, are you raising capital the same way that you would raise for these syndications? It's just the timing and the payouts is probably going to be a little bit different, or is it on par?
That's correct. So the big difference between the existing apartments and the brand new construction is existing ones, the cash flow, right? The cash flow, and we can do the distributions right away. On the construction, until we construct it, obtain a certificate of occupancy, and until we fill it up, there's not much cash flow, right? No cash flow, actually. I should say no cash flow until that happens. And once that happens, you can do one or two things. You can actually sell the property right then and there, so around 2.5, 3-year mark, and then distribute the money and go away. Or you can refi and give investors back most, if not all, of their money, and then hold the property for next 2 to 3 more years, optimize the expenses, increase the income, and sell it at a much higher profit at the time, right? And you will have cash flow after that event. But you have so little money left in the deal after that refi, it makes a whole lot of sense to hold it much longer, waiting for the right price.
Is raising capital going to be different? Like, most people that are interested in, investing into multifamily, they're kind of expecting those, quarterly distributions right away.
I can tell you this much. The lure of this passive monthly or quarterly mailbox money is unbelievable. People love it. Right? So the task I have right now in front of me is like to change people's minds to invest here also with construction, unless they absolutely need that cash flow to live on it. You see what I'm saying? Just don't do it because it feels you'll feel good about it. But I understand, right? Somebody actually is counting on that money to pay their bills. Oh, of course, right? There's nothing to talk about there. But if you don't have to have that cash flow, let's focus on building wealth, higher returns, and a better risk to reward ratio, right? Because whatever you build right now, it's even expensive to build next year, even more expensive to build next year, right? And also we are dealing with a brand new property where your expense ratios are so less compared to existing property. The difference can be like even in Texas, which is high insurance and high tax market, high property tax market. The difference can be on a brand new property, 35% expense ratio. On an older property, 70% expense ratio. So you get to keep more of the same rent dollar if you have a newer property, because you have R&M is a breeze, right? Better quality tenants. They won't trash your place on your move out. Maybe you can just do the make ready with $100. Maybe you just have to clean after a tenant. Whole different ball game, right? Newer property, better tenant, easier to deal with, no pipe separations, chiller downs, nothing like that, right? So there's definitely makes a whole lot of sense for us where the BNC now. Tomorrow, God forbid, if BNC prices go back to $30,000-$40,000, I'll ditch the construction. I'll go back there, right? The only reason we are talking about construction is because the existing B and C class apartments, their prices have appreciated so much. It became a super thin margin business. I'm not saying there's no deals exist where we have much bigger margin, but they're slim to none, right? I mean, it's really, really hard to find those.
And
so that's why construction offers a better risk to reward ratio for us.
And have you had any struggles with, because you're probably, when you're raising capital, it's probably a majority of your existing, clients, people that have been kind of working with you for a while. When you're going into this new venture, though, are you still utilizing those same clients, or do you have to go out and find a different
we are
batch?
sending it the same people, but not everybody are excited about it. But they are on the very first deal. So let me, on our existing apartment deals, our very first deal, we raised 1.2 million, then 1.8, then 3.8, and then 5, 6, 7, 8, 9. At any given time, we were raising anywhere between 5 to 9 million per deal in 2 months span, right? But construction, we have the same list. We don't have a separate list. So we are sending those deals to the same people. We started small. So our very first deal was 3 million raised, just 3 million. It was easy. Easy is a relative word. I shouldn't keep saying the word easy. Nothing is easy, right? If it's easy, everybody would do it. But the perception of mine after doing all these deals, this was not very hard. But the second deal, we raised 5.4 million. So did okay as well. And even though that's retail, some of the money we raised after COVID, where retail is like, oh no, kind of a word. So people still believe in that again, because this is a very specialty retail geared towards affluent kids in a very affluent market. So we were able to get away with that. And the third deal that we are yet to raise is about $5 million. So we're slowly scaling up. What we won't do is to go and start to raise like a $10 million, $12 million on a brand new construction deal, because we're in the process of training our investors to look our way, right? To understand what we are saying. And it takes some time for people to finally make their peace saying that, yes, it makes sense.
Is the return less because the capital that's not being utilized during those 2, potentially 3 years, are the returns still as good as if they were to go with something where maybe they're able to get those distributions sooner, or is it pretty or is it
that's a
greater?
great question. So in order to answer that question, we have to talk in terms of IRR, right? Because that measures the time value of the money. So we're doing a deal here in Colorado. We just wrapped up the money raise on that one. So on that deal, we're doing 90% in 5 years. That's a 15.76 IRR. But this deal that we are about to do, the construction deal, will be at a much higher IRR, like a 20s, low 20s. So there is a big difference. But when will you get paid is the question, right? I mean, again, there's no cash flow distributions on this thing, right? So that's the difference. But the whole point, so an investor would think, why should I invest if I get the same IRRs? There should be some give and take. The give is foregoing the distributions, right? But the take is higher IRRs to the investors. And also the execution wise also, right? I mean, I have to stress the importance of that. You can underwrite whatever you want, but delivering that is a whole different ballgame in operations. Again, I told you, right? I mean, several things have to. Again, if you look at Texas market, I think you're in DC, right? I mean, not sure how that market is, but our insurance is pretty high, one of the highest in the country, in the top 3 or top 5 in the country, because we get a lot of environment related, like weather related incidents and all that, right? So they keep going up. When I started this business in 2016, we were paying $200, $225 a unit per year. Now we are at $700. Did my rent went from $500 to $1,500? No, right? Same thing with taxes. Texas doesn't have state tax. Awesome. But they come after us on the property taxes. And the assessment, I mean, it's pretty hard. It's going to be even harder next year because almost the entire country, all the governments are bankrupt or near bankruptcy, right? I'm talking about state and municipal governments, right? So in Texas, their only major source of income is this property taxes. Pays for schools, pay for city services, county services, and all that. So they're going to come after us pretty strong. So hitting your numbers become, and especially when you're using third-party management, we discussed the issues with the third-party management, right? That the whole thing that brings. So delivering the results becoming pretty hard. on the existing B and C class properties. Now you can go buy an A class property, but the yield is not there. That's for institutions. So what we want to do is we want to generate B and C class returns by building A class. Not technically buying an existing A class, but building A class. We won't even generate better results. An investor doesn't care. Dollar is a dollar is a dollar for them, right? So we want to do it in a much more sensible way where we can keep repeating.
What would you do differently if you had to start from scratch?
See, that changes quite a bit from time to time, but the cycle where we are in right now, it's going to be hard. But what, again, I would say is definitely partner with people. Again, I did. I'm just saying that these are some of the good practices. You make a list of all your strong points and your weak points. Get a partner who can cover you on those weak points. I mean, there should be yin yang between the partners. Don't pick somebody who's exactly like you, right? He has to be. My partner is like opposite to me, right, in several ways, and that's why we gelled together and came this far. So I would say that. And the second thing I would say is that equity is something that you have to, that's a constant process. It's easy for us to put in a call into New York and get a term sheet. Somebody will write you a check, but you would hate the term sheet. I mean, it'll be horrible. So basically, there'll be heads I win, tails you lose kind of a term sheets. I mean, that's how they roll, right? But so that's why we work with our investors and share the wealth with them rather than a company out of New York. And again, it's not me throwing them under the bus or anything like that. There's definitely a purpose for that. But then again, given the deals are so with skinny profit margins and all that, they're just not viable. 5 years before, all day long. Now, not so much, right? So I would say that, again, I don't know what I would do differently. Yeah, one thing which we talked about it, right? I would have skipped the whole single family game altogether. At the time, I felt good, I felt accomplished and all that, but it did not bring any material change in my life. I still need that W-2 job. I still have to show up 9 to 5. I would just completely, if I can go back in time machine, I would completely skip that whole episode of my life and started with multifamily back in 2007.
And what question would you have for someone that's maybe at a similar size than you, or maybe that next level where you're trying to go? What are the types of questions that you have in your business that you would be asking them?
I would be asking them something like, well, where is it making sense? Which markets, which asset classes? Again, we don't want to just limit it. We started with apartments and we are doing a retail deal right now, but we don't want to limit ourselves to just apartments only, because every asset class has cycles. Every asset class has ups and downs. So it's okay to be with apartments. It's relatively evergreen. But if there is anything else, like for suppose industrial, right, makes a whole lot of sense, right? And I don't think industrial is a fad right now, because all these brick and mortar stores are closing up while the online retailers are going big and big and bigger, and there is insatiable demand of good quality industrial commercial real estate. So that is something that we like. Storage is something that we like, but we like industrial more. So what I would ask for somebody else is like, help us determine, okay, where is the prospects better than apartments, better or even same. Even if it's same, I want to provide some diversity for my investors, right? So that is what I would like to know. Which pockets of the country, what's the story ongoing on which pockets of the country, and which asset classes are outperforming apartments, and to know more about those.
And do you think that that's not overstretching yourself or stretching yourself too thin going into different types of classes, or do you think that it's okay?
It's okay, because see, again, if I'm trying to be a property manager for all these different things, I completely agree with you. We are definitely overstretching us. But the idea is to leverage other people's time and services and know-how, right? So we are going to bring in experts no matter what we touch. Even if you look at the development projects that we're doing, right, we are not developing it ourselves. We're partnering with somebody who has done this so many times, right? So we don't see it that way. I think it becomes our job and our duty to always keep an eye out to find out what else is going on and bring the quality deals with diversification and better and better risk to reward ratio. We always have to keep that in mind. Risk to reward ratio has to be the number one thing of everything that we do. Let's say a property comes on, it's in a great area and everything, but how much do they want? $200,000. Okay. So how much you can sell it for? Maybe 230. Well, if market doesn't work, where can it go? 100, right? So $30,000 upside to $100,000 downside. So you have to think in this kind of perspectives, what can go wrong versus what can go right. And it always have to be favorable. And that doesn't mean that, you can only buy apartments and you can only buy in your market. So that's why it becomes our duty to see the whole asset classes available and the whole markets that we can get into.
And what's the best way, Venkat, if anybody wants to be able to reach out to you, if they have any more questions or they want to find out more about Raven MF Multifamily and what you guys do?
Sure. They can drop an email at Venkat, VENKAT, at ravenmultifamily.com, or they can give me a call at 281-727-9238, and definitely check out our website at ravenmf.com.
Awesome. Thank you so much, Venkat, for taking the time. And until next time, deal makers, talk to you later. Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.